Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Eric Sterner. He's Chief Investment Officer at Apollon Wealth Management. We're going to discuss why positive returns for 2023 might come from the fixed income side of the portfolio. Eric, it's great to see you again. Welcome back to TradeTalks.
Thanks for having me on the show, Jill.
Before we get into fixed income, let's talk about the macro environment and your near-term outlook. With equities, do you think we might hit those lows?
Yeah, I think in the coming months we're going to retest those October market bottoms, and we're starting to see the earnings deteriorate. Just last quarter we saw earnings were down 5%, and I expect that to continue. We all know that the rate hikes take some time to be fully digested, absorbed into the economy. And we're starting to see those effects, and just last quarter, nearly 4 times as many companies issued negative guidance as opposed to positive guidance. So I'll be listening just like everyone else as first quarter earnings season kicks off, but I expect the earnings to continue to go down in the coming quarters.
Well, it will be nice to focus on fundamentals and kind of get out of this macro mindset that we're in when it comes to Fed policy and interest rates for longer and so forth. But I have to ask you this. Do you think the Fed can get to its 2% inflation target, or is that a bit ambitious for 2023?
I don't think they're going to get to 2% this year, potentially next year. I think we still have some upward pressure on inflation. There's still a lot of demand for services that are happening right now, and if people have jobs, they're going to keep on spending money. And we know that labor market's really tight right now because we have nearly 2 million people out of the workforce since the pre-pandemic, and that's keeping that labor force tight, and it's putting pressure on wage growth, which is going to put pressure on inflation. So I think over time, we're going to have to see that unemployment rate go up in order for demand to go down and inflation go down. So it will take some time. Hopefully, we'll get it down to 3.5% by the end of this year. But as we go down, I think it's going to get harder and harder to get it down to that 2% target level. And as we backpedal from the globalization movement, I don't think 2% is going to be the normal rate. I don't think anyone knows what the normal rate's going to be, but time will tell, hopefully in the next 2 years, of what that new inflation rate will be.
It's interesting because you brought up labor, and of course we got some data out this morning, and we're still not continuing to see any drops, right? It's as strong as it has been. I wonder, we heard all about the tech layoffs and so forth. They're not filing claims. Perhaps they got laid off, have their severance, and just beelined into another job. I mean, those are the kinds of jobs and skill sets that are in demand.
Yeah, I mean, and the technology layoffs are the big headlines, but that's only 2% of the workforce. And what's really driven these labor reports in the last few months is more on the leisure and hospitality side, the service sector, as they're still regaining jobs from the pandemic. But for a lot of those companies in that sector, they depend upon smaller banks for their lending. So based upon what we went through with Silicon Valley and Credit Suisse, we're going to see some tighter financial conditions, and that could cut back on some of the job growth on the services side of our economy.
Well, I mean, that also lends to what could potentially be a recession as well if you're not lending fresh capital out to small businesses, which are such big employers of U.S. jobs here. So what are your thoughts on recession? Soft landing, hard landing, maybe a little bit more prolonged, but not quite as hard?
Yeah, I think we're going to have a recession. I mean, there are so many data points that are pointing to it. The yield curve is more inverted than it's been since early 1980s. We've seen 11 months in a row of leading economic indicators be negative. And just due to the Fed rate hikes, we're in very restrictive rate levels, and we're going to be under those rate levels for all this year, I believe. And that's what the Fed has told us. I think some in the market are anticipating some rate cuts, but Powell and the Fed have made it very clear that their number one objective is to tame inflation, even if it comes at the cost of financial pain for many, which it will, as the unemployment rate will go up. So I do think we'll see a recession come about, and either later this year or potentially in 2024.
And while you normally advocate for equity allocations, you do think that the return's going to come from fixed income in 2023?
Yeah, absolutely. I think we are going to, like I said, retest those market bottoms. But the great news from all these rate hikes is it's helped really set up fixed income. I mean, we're seeing 6-month Treasury yields at its highest level in 16 years at 4.8%. So why take all that risk in the equity market if you can instead earn 4.8% on a treasury bill. I do think in the long run that equities are the main engine for investors to achieve their financial goals. But in the short term, I think the fixed income markets are a much better alternative looking 6-12 months out. Even investment grade bonds are paying nearly 6% right now. And that's what I would really advocate for, knowing that, or my belief that we're going towards a recession, stick to high quality, both on the equity side, but also the fixed income side. Maybe shy away from high yield for now, but look for those treasury options or even investment grade options to get us through this time until we can get inflation down to normal levels, and then hopefully set us up for a sustained bull market on the equity side.
All right, Eric, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.